Hey everyone, welcome back to Corporate Decoded, the place where we break down big corporate secrets. And today we're diving into the Hartford Schroders Private Opportunities Fund. Its latest prospectus is a real deep dive into the world of private equity. And let me tell you, it's not for the faint of heart. We're talking about investments that are far from your everyday stocks and bonds. So buckle up because this is going to be an eye-opener. And hey, if you like these kinds of unfiltered looks at how money really works, make sure you're subscribed and join our Discord community linked below for even more exclusive insights. So what's the big story with this filing? It's a look at how the Hartford Schroders Private Opportunities Fund plans to invest your money specifically in private equity, which means companies that aren't traded on the public stock market. It's a world of buyouts, growth capital, and venture capital, all aiming for long-term growth. But it comes with its own set of serious risks. We're talking about illiquid investment shares you can't easily sell, and a whole lot of complexity in venture capital, all aiming for long-term growth, but it comes with its own set of serious risks. We're talking about illiquid investments. Shares you can't easily sell, and a whole lot of complexity. Let's jump straight into the numbers. The financial highlights give us a glimpse into the fund's performance since it started in July 2023. For the year ending March 31, 23, for the year ending March 31, 2025, Class A shares saw their net asset value grow from 10.25 Class A shares, saw their net asset value grow from 10.5 Class A shares, saw their net asset value grow from 10.5 Class A shares, saw their net asset value grow from $10.5 give us shares, saw their net SER shares also saw similar growth in their net asset value, which is a good sign for investors. Now, the total return for Class SDR shares for the year ended March 31, 2025 was a respectable 14.70%. That means if you invested $100, you would have seen a growth of about $47 you would have seen. As for Class A shares, their total return for the year ending March 31, 2025 was also a strong 14.70%. Adds significant improvement in performance for Class A shares. The fund's overall performance seems to be on a positive trajectory. Trade 80 ending March 31, $100 U shares was nearly identical at 14.70%. As for Class A shares, their total return for the year ending March 31, 2085 was also a strong 14.27, so there's been a significant improvement in performance for Class A shares. The fund's overall performance seems to be on a positive trajectory. But here's where things get a bit more detailed. The expenses are quite substantial. For Class A shares, the total annual operating expenses before any fee waivers were a whopping 7.17%. That's a lot of money going to fees even before we consider the acquired fund fees and expenses, which add another 0.42%. For Class I shares, the total operating expenses are 6.57%. And for Class SDR shares, it's 6.32%. These numbers are significantly higher than what you might see in a typical mutual fund. The good news is the advisor has agreed to waive the management fee by 1.0% at least until July 2026. This helps bring down those high total expenses, however, even after this waiver and expense reimbursement. The total annual operating expenses for Class A shares are still 2.52%. For Class SDR, it's 1.67%. These are still pretty high fees, which means the fund's investments need to perform exceptionally well just to cover costs. Let's look at the example here. Forever, even after this waiver and expense reimbursement, the total annual operating expenses for Class A shares are still 2.92%, and for Class SDR, it's 1.67%. These are still pretty high fees, which means the fund's investments need to perform exceptionally well just to cover costs. Let's look at the example here. For every $10 invested, a 5% annual return would mean paying 60 for 5% annual return, would mean paying 65% annual return, would mean paying 65% annual return, would mean paying 60 service and expenses for Class A. The fund's strategy is focused on private equity investments, which are inherently riskier and less liquid than public market investments. Unlike many closed-end funds, these shares are not listed on any exchange, and there's no expectation of a secondary market developing, meaning you might not be able to sell your shares when you want to or at all. The document highlights that this is an investment with a high degree of risk, and they even suggest you should not expect to be able to sell your shares regardless of how the fund performs. It's considered an illiquid investment, and to provide some limited liquidity, the fund plans to offer to repurchase shares only once a quarter, and the board has complete discretion on whether to do any repurchasing at all. So don't expect easy access to your money and a quarter. And the board has complete discretion on whether to do any repurchasing at all. So don't expect easy access to your money. Digging deeper into the risks, they really emphasize the illiquid nature of these private equity investments. They talk about a J-curve performance, common in private equity, where you see declines early on before potential gains later. And then there's the valuation risk. Private investments are hard to value, and these valuations are determined by internal pricing methodologies, which involves a lot of subjective judgment, so the net asset value might not perfectly reflect what you could actually sell the investment for if you had to determine by internal pricing methodologies, which involves a lot of subjective judgment, so the net asset value might not perfectly reflect what you could actually sell the investment for if you had to. The fund may use leverage to borrow money up to certain limits. This magnifies both potential gains and losses, making the fund's net asset value more volatile. They also flag market risk, which is the risk that markets go down in value from economic or geopolitical events. And it's noted that these events could prevent the fund from executing advantageous investment decisions, which is a pretty direct warning. The fund's repurchase offers are a critical point. There's no guarantee these offers will even happen. And if a lot of people want to sell their shares, the fund might only buy back a portion of them, meaning you could be stuck holding your investment for longer than you planned. And if you sell within a year, you'll pay a 2% early repurchase fee, unless the fund decides to waive it. The document explicitly states it doesn't expect any secondary market to develop for the shares, meaning you can't just sell them on an exchange like a regular stock. And while they might offer quarterly repurchases, there's no guarantee you'll be able to sell when you want or in the amount you desire. Looking at who owns the fund, as of June 2025, Hartford Funds Management Company holds 100% of Class A shares and significant portions of Class I and SDR shares. Schroders US Holdings Inc. also holds a large chunk of Class SDR shares. This concentration of ownership could mean that major decisions are easily influenced by these large holders. The expense structure is also worth noting. Class A shares have a management fee of 1.50% with additional other expenses leading to a total of 7.17% before waivers. Class I shares have slightly lower expenses at 6.57% and Class SDR shares at 6.32%, while there's a management fee waiver bringing those total annual operating expenses down significantly after waiver. And as the cost is down significantly after waivers, the costs are still quite high, making it crucial for the fund to perform very well. Interestingly, as of June 30, 2025, Hartford Funds Management Company is the sole record holder for Class A shares, which is quite a concentration for that share class. So what's my take on all of this? Hartford Schroders Private Opportunities Fund is targeting a part of the market that offers potential for high returns, but it's also fraught with complexity and a significant lack of liquidity. The high fees are a real hurdle, and the fund's dependence on the performance of its underlying private equity investments. And the fair valuation of those illiquid assets poses considerable risk. The lack of a secondary market and the limited quarterly repurchase offers mean this is definitely a long-term investment for those who can truly afford to have their capital tied up. With its focus on private equity and the inherent risks involved, this fund is not for the average investor. Its success hinges entirely on the skill of its managers in sourcing and profiting from private deals and navigating extreme valuation challenges. My overall assessment is that while the returns could be attractive, the risks are substantial. And investors need to be fully aware of the illiquidity and the high expense ratios involved. Alright, that's our breakdown of Hartford Schroders Private Opportunities Fund's latest filing. What's your take on these numbers, and what do they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out the Discord in the description below to join the conversation with other finance enthusiasts. Thanks for watching. See you next time.